Hello, my name is Richard Goldstein. I'm a partner in the pensions group at Mayer Brown. Welcome to the third episode of our new monthly series. In these videos, we cover different topics each month, providing an overview of issues faced by pensions industry practitioners and offering some practical insight. Please contact us if you require further information, and details will be provided at the end. All videos are available on Mayer Brown YouTube channel, and you can subscribe to this channel so the new episodes are shown automatically in your subscriptions feed. In this episode, I'm going to talk about Equitable Life's proposal to convert its with-profits policies into unit life policies and to transfer them to Utmost Life and Pensions. A with-profits policy is a type of insurance policy under which the premiums paid by policyholders are used to create an investment fund. The value of the fund will depend on the investment returns on the fund's costs and charges and other profits and losses of the society. Investment returns are smooth to try to avoid the risk of short-term volatility. Upon payment, a capital uplift may also be payable. In addition, most policies have a guaranteed value, which is the minimum paid out on retirement, maturity, or death. A unit-linked policy is another type of insurance policy. Here, the premiums paid by policyholders are used to purchase units in an investment fund. The value of the units move in accordance with the performance of the fund, and the return on the policy is therefore determined by the price of the units at the point the policyholder becomes entitled to payment under the policy. Unlike a with-profits policy, a unit-linked policy does not guarantee that a minimum amount will be payable under the policy. In August 2019, Equitable Life issued a proposal to all holders of its remaining with-profits policies to convert those policies into unit-linked policies and to then transfer them to Utmost Life and Pensions, formerly known as Reliance Life, along with Equitable Life's other unit-linked policies, subject to a few exceptions. In return for giving up any guarantees connected with their with-profits policies, policyholders would receive a higher capital uplift, which is expected to be in the region of 60 to 70%, but can be higher. Policyholders will be required to vote on whether or not to accept certain aspects of the proposal, while court approval will also be required for other aspects. Many trustees of DB schemes in the UK hold Equitable Life with-profit policies for the investment of additional voluntary contributions, or AVCs. These trustees will need to take decisions on behalf of the scheme members with the relevant AVCs. There are effectively two decisions that trustees holding Equitable Life with-profit policies will need to consider and make. The first one they have to decide is whether or not to vote to accept the proposal. This decision has to be taken by 30th of October 2019, and because of the technical process that needs to be followed to achieve the proposal, the trustees will have actually two votes to exercise. The first one is a vote to approve what is known as a scheme of arrangement, and this is the legal process for converting the policies. The second is a vote to amend the Articles of Association governing Equitable Life in order to facilitate the transfer of the converted policies to Utmost. The actual transfer of the policies does not require policyholder consent. However, it will require court approval through a statutory process. As the recent court decision on the proposed transfer of Prudential's £12 billion annuity portfolio to Rothsay Life illustrates, it is by no means a foregone conclusion that the court will grant approval for this type of process. If the trustees thought it necessary, they would be able to make representations to the court about the proposed transfer. In exercising its votes, the trustees can vote in favour of or against the proposal, or they can split their vote, i.e. vote for and against the proposal in different proportions based on the value of the policy. However, trustees should be aware that even if they vote against the proposal, if a sufficient number of policyholders vote in favour of the proposal and the court sanctions the transfer of policies to Utmost, the trustees will be bound by the proposal. It is unlikely to be in members' best interests for trustees of pension schemes simply not to vote on the proposal. In fact, by not voting, trustees would be contributing, albeit in a very small measure, to the possibility that the proposal does not go ahead. If the proposal doesn't go ahead, Equitable Life are likely to try again in perhaps 5 or 10 years with a revised proposal, but the revised offer may be more or less attractive. There is no statutory requirement for trustees to have to take regulated investment advice on the 2 votes. However, given the nature of the decision and the different factors that trustees will need to weigh up across affected members, trustees are likely to take advice from their investment advisors on the proposal. If the proposal is accepted by a majority of policyholders and sanctioned by the court, the trustees have to decide whether or not to accept the proposed default strategy for mapping the converted with-profit funds to the new range of unit funds offered by Utmost. This decision has to be made by 13th December 2019. Under the proposed default option, assets will be held in a cash fund for 6 months and will then be transitioned to an automatic investment option. Alternatively, policyholders can 1. Choose a strategy that adopts different investments based on the member's age. 2. Choose a strategy that adopts different investments based on the member's attitude to risk. 3. Self-select between different available funds. Or 4. Choose a combination of the above options. Our understanding is that trustees will be able to specify investment choice at the member level. New Utmost funds would be bought on 1st of January 2020. In order to consider the suitability of the default option offered by Utmost, trustees will be required to take regulated investment advice. Note, existing unit-linked funds will not be affected by the transition to Utmost. There is no requirement to canvass members' views on the proposals. While each member's personal circumstances are different, trustees are not required to consider the position for each member, but rather the position for members in general. Trustees will, however, need to send a communication to members to inform them about the proposal and to allow them to make an investment choice in time for the 1st of January 2020, as well as explain to members what happens if no choice is made. Trustees are not required to provide members with paid-for investment advice or indeed access to any investment advice. If members raise questions, they should be referred to information on the Equitable Life and Utmost websites or the telephone helplines. As a further practical point to bear in mind, trustees will want to check retirement ages shown in the Equitable Life data against normal retirement ages in the scheme under the scheme rules. This is because the uplift to policies with a guaranteed interest rate is higher if a member's normal retirement age is higher. That ends this video. Please feel free to email me with any comments or questions on this video to rgoldstein@mayorbrown.com. That's rgoldstein@mayorbrown.com. This video is an overview of the law in this area, and how the law will apply in any particular case will depend on individual circumstances. Please therefore remember to seek legal advice on your particular circumstances.